Hello and welcome to Looking at the Markets with David Modell. I've got a really simple trading strategy using 3 different moving averages, and it can help you to identify a strong upward trend and the pullbacks that you can buy if you want to. All right. Now, this strategy is not perfect. It does not work 100% of the time. Make sure you're using some sort of exit strategy. That means it could be a stop loss. Whatever amount of money you're willing to lose on the stop loss, be ready to lose it, okay? And don't just use a strategy with real money until you've tested it out with demo trading, virtual trading, whatever it is, okay? All right, so this is tradingview.com, and I'm using Apple stock, the 1-minute candlestick chart, although this strategy can be used with different time frames than 1 minute. You can use bigger time frames than that. Because the lines, these are moving averages, they will adjust to the candle time frame, whatever it is. All right, so I have 3 moving averages up there, and they're all EMA. They're all exponential moving averages. So I have the 50-period EMA, and that is in blue here, darker blue. And then below that here, I have in light blue the 100-period EMA right here. And then on the bottom here in yellow, the 150 period EMA. So I got the 50, 100, and 150 period EMA. All right. And it's an uptrend confirmed when it's in that order. It's got to be in the right order. So 50 on top, 100 in the middle, and then 150 on the bottom. It should be in that order. They shouldn't be super close together like they are here. And they definitely should not be in the wrong order like they are over here. Okay, so with this strategy, and again, don't just trust the strategy, test it out with demo trading, virtual trading first, make sure it works. But with this strategy, if you have the 3 moving averages in the right order, then you have a confirmed uptrend, and that's when you can go long. That's when you can be a buyer, but not yet, all right? What I'm saying is don't even consider being a buyer unless the moving averages are in the right order, 50 on top of 100 on top of 150 EMAs. If you have the right order, then you start watching it. If it's in the wrong order, you just stay away. You don't even consider going long or buying. So if they're in the right order, then you look for the candles, and here we have 1-minute Apple stock candles. You wait for them to touch the 50-period EMA, which should be on top if they're in the right order. Okay, it's this line right here, the dark blue one. You wait for it to touch it, and then you want a candle that's completely above it. All right, because you don't want to catch a falling rock. All right, if it pulls back in an uptrend, that's good, but if it's just going down like a falling rock, you want to stay away. So you want to look for a candle that closes above, and I'm going to zoom in here to show you what that looks like up close. Okay, so hopefully you can see it. All right, so we had a touch of the 50 EMA, but then the next candle didn't just go above it, it actually closed above it. It closed right here at the top of the green candle, the top of the body of the green candle, I should say. You could have bought here, and then you would have done pretty well. All right, now this is a very short-term strategy. All right, and this method does not give you an exit. You can use, let's say, a 2-to-1 reward to risk ratio where you have a stop loss below and then a profit target twice as high as that kind of thing. All right, I'm not going to go into a whole explanation about a 2-to-1 ratio, but this does not tell you the exit strategy, just the entry. All right, you want to respect your stop losses or have an exit strategy of some sort. All right, so let's say you took profits there, fantastic, came down, didn't exactly touch the 50-period moving average. It did touch it here. I know it might be hard to see, but it actually touched it here. And then the next candle closed above it. Very nice, closed above the line. You could have bought for some good profits, all right? And it keeps working over and over, at least in this case. Not in real life necessarily. It's not a perfect strategy, but here it worked out pretty well, okay? Touched it, all right? And then, you know what? You had a green candle that closed above it. It went down, but not for very long. It wobbled around, that's fine, and then boom, it went up, okay? So don't expect it to work immediately perfectly, all right? But this one worked out quite well. Now, let's take a look at a counter example, all right? So I would not have taken any trades over here. Why? Because the lines are not in the right order. 50 on top of 100 on top of 150, not over here, okay? All right, or over here, forget about it. It's just a jumbled mess. I don't even touch it, all right? And some people, first thing in the morning, they may choose to avoid the first 15 minutes or the first half hour, whatever your choice might be, just because there's going to be so much volatility in that first 15 minutes or that first half hour that these lines might not be so reliable. You might choose to wait until after the volatility has subsided. Also, the last 15 minutes or last half hour, the trading day for stocks can also be volatile. So you might choose to avoid the beginning of the day and the end of the day. That'll still leave you the vast majority of the trading day to be able to use this strategy if you choose to do so. So I hope this was helpful to you. If you like this, then please give it a thumbs up and subscribe to my channel if you haven't done that already. And I'm going to keep on bringing you different strategies as I find them. So thank you so much for watching and listening. I will talk to you again soon.